To our Global Equity Market 2026 webinar. My name is Jillian Wolf. I'm a Global Equity Strategist here at BI. A few housekeeping items before we get started. There will be a replay available of this webinar, and these slides will be shared on the terminal. If you would like access, you could also email any of us individually. We're going to be going through basically every major equity market today. I'm going to kick this off with a broad global equity overview, pass it over to my colleague Mike Casper that'll walk us through the US, Laurent Dulette, who will go through Europe and Japan, Marvin Chen, who will go through emerging Asia, Jenny Lee for Latin America, and Andrew Martinov. Again, we're going to leave about 15 minutes at the end for Q&A. You could drop any of your questions in the chat. And we will try to answer them either on this call or respond to you via IB or message. Last housekeeping item is just a small pitch for Bloomberg Intelligence here. We have over 500 analysts with 15 years of experience on average across Bloomberg Intelligence covering strategy in almost every individual company within the MSCI ACWI across the globe. If anybody has any individual questions about particular stocks or particularly lines of strategy beyond equity, we have a very large department here, and we can definitely match you with someone who could help provide answers to any of your questions. So starting off again with this broad global equity outlook, what we saw and what we're looking for heading into the new year, really one of the major stories of 2025 was U.S. underperforming both emerging and developed markets outside of the U.S. across the globe, which is really a rarity during a broader global bull run. We did see this in 2022 during the bear market where the U.S. underperformed when all markets were down. The U.S. was down a little bit more. But even with the U.S. market up well over 12% this year, it was still beat out by basically every other major market in 2025. Tech was not actually the driving factor of 2025. Materials, financials, and industrials really ultimately came out on top globally. Part of that was the gold trade. Part of that was falling rates that allowed financials to re-rate. Concerns about Liberation Day and Trump policies definitely took a toll on the U.S. earlier in the year and made it very difficult for them to catch up towards the end. It was basically a year of catch-up for U.S. equities, and made it very hard for them to ultimately close the year outperforming even into the first week of the new year. That said, we're a bit more positive on how the U.S. will shape up relative to the rest of the globe heading into 2026. It is rare and almost historically unprecedented for the U.S. to have 2 straight years or 2 consecutive years of underperformance versus international stocks. We do see a few headwinds for the U.S., but we think that the tailwinds ultimately will outweigh those. Going through this, one thing that we're not too worried about right now is the broader economic context and how that's driving equity markets. Our economic scorecard here is telling us that across the developed world, including the U.S., no economy is performing that strongly relative to its own history, and that's leaving equity markets somewhat unmoored from the economic story. This table here shows the percentile ranking of each of these economic factors relative to their own histories, and every country, major economy in the developed world is performing at a below average pace. So that hasn't really given investors any cue as to where markets might go. There isn't a major leader or laggard just yet. And then really until one emerges, it's likely not to drive the equity market near term. Earnings growth in 2026 is looking to favor the U.S. In 2025, the U.S. outperformed developed ex-U.S. markets in terms of earnings, but did lag emerging markets significantly. This was mostly because of the semiconductor rally that was driven by some of those Southeast Asian names, as well as Korea. One thing to note is that the 2025 outlook has come out basically as strong for earnings across the largest companies around the globe as it was prior to Liberation Day. So analysts expected a little over 10% growth prior to Liberation Day. Those estimates dropped really significantly back down to about 5.5% by the summer. They've now been revised back up to that 10.5%. So tariffs really didn't take a bite across the globe. The 2026 outlook is steadily increasing, but one thing I'd like to note is that a lot of that is reliant on the fact that analysts are becoming more optimistic on AI-related firms' earnings growth, and that's actually offsetting a little bit of a deterioration in the outlook of non-AI companies right now. But broadly, the story is tariffs didn't ultimately really have much of an impact on the overall earnings stream globally, and the 2026 outlook is still quite strong and favoring the U.S. in the next year. One major tailwind for the U.S. is right now is we're looking at valuations. The premium to international equities that the U.S. had going into the year was really extreme. That's now normalized quite a bit, particularly if you look at the median stock. It's right around its 10-year average premium relative to the median international stock. The index is still a bit elevated, but that's a bit distorted by some of those Mag 7 names. One thing we do want to point out is how expensive financials have gotten, really across the developed world and partially in the emerging markets as well. We've seen a massive re-rating in financials, not necessarily to say this is an unfair re-rating, but it's something to keep an eye on. I think there's a lot of talk about how expensive tech has gotten, and this has fallen a bit by the wayside of how expensive financials are starting to get in both the US and abroad. So if you're looking for valuation pressure into the next year, it's less likely to come from the US itself and perhaps more from the financial sector that might have less room to grow. It was, again, one of the best performing sectors globally in 2025, so might meet some resistance heading into 2026. One thing we want to note about what also might be a major driver of 2026 is theme concentration weighting in the MSCI indices. So one thing we want to note is that if you are benchmarked to a weighted index, let's say the US weighted index, about 43% of your weight is tilted towards artificial intelligence. 34% of that weight is towards the metaverse, et cetera. We've seen a significant impact of how AI performs versus which regions outperform. And we think more and more heading into 2026, thematics are going to drive which region does the best versus to the traditional factors like valuations, fundamental growth, and economies. It may more come down to which regions are most exposed to the key themes that are poised to do best in the next year. Briefly on the AI thesis, we still see that in the US, most of the CapEx spending by all US firms is being spent by those AI firms. It's over 35%. There's less CapEx concentration in emerging markets and virtually none in developed ex-US markets. Still seems as though US firms that are growing their AI spending, or US AI firms that are growing their CapEx spending, are rewarded for those earnings calls where they announce that data. Outside of the US, it's a little bit more mixed, but it seems like people are still quite bullish on AI spend. One other thing I want to point out is as these thematic drivers start to take a larger toll on the equity markets, we might be looking at more dispersion going forward. So 2025 was one of the highest dispersion years in terms of returns between different equity markets. So that if you were just take the overall 1-year return between the major 20 markets, the standard deviation between those returns was its highest level since prior to the great financial crisis. A lot of this is really being driven by the fact that these themes are driving certain markets like Korea or Taiwan or the US when they start to take off very fast, and some markets start to lag quite quickly as a result of that. AI overall is still being broadly mostly mentioned just within the tech sector, and particularly within the developed market space, there's a lot more skepticism about how AI will be used. Not necessarily signs of a bubble just yet, but something that we think that's worth noting out is that public companies, at least in developed markets outside of tech, aren't really talking about utilizing the technology that much just yet. One final point I'd like to make is about how AI has transformed the market dynamics for emerging markets versus developed markets, and how that relates to the dollar. So typically, as the dollar strengthens, developed ex-US markets outperform their emerging peers. We're starting to see a bit of a shift in that dynamic now that a lot of these emerging markets names are more reliant on US revenue to fund the AI supply chain. So now we do not think that a weakening dollar, for instance, would be as detrimental to the relative performance of those two markets as it has been in the past. A much larger percentage of emerging market revenue is being earned by the US now, and it's actually starting to converge on an index-weighted basis with developed ex-US markets as those markets become more integrated into the US supply chains and US demand. With that, I'll kick it off to my colleague Mike Casper to go through a brief US equity outlook right now. Thank you very much, everyone.
Oh, sorry. Before I get started, I have a link to our U.S. Outlook call, our full U.S. Outlook call, which lasted about an hour. If you would like to see the full version of this presentation that I'm about to give, please reach out. I can send you a link to that. I'm only going to speak for about 5 minutes, I promise. But getting into the U.S. side of things, our market health checklist, which is our 17-factor bullpen of things that we like to look at for equity direction in the U.S., largely green. If you looked at this in the beginning of 2025, most of the factors that we looked at, I would have assessed as red, and we did assess as red at the time, especially going into Liberation Day, that those deteriorated on the macro side, I would say especially. But since then, we've seen a pretty steady recovery in the earnings stream. Technicals have gotten significantly better. Still, I would say macro is the thorn in the U.S.'s side. Our economic regime model, which uses 4 factors, I would say the big highlight from the economic regime model being ISM, just being persistently weak for the better part of 2 years. The longest stretch ISM has been in contraction outside of the great financial crisis. Economic conditions for the U.S. are weak, and that would be the main thorn in the side. There is still room for recovery, obviously, again, mostly on the economic side, but I would say most of the sentiment recovery from the washout that we saw during Liberation Day and right after has all been priced into the U.S. Obviously, we're back to all-time highs. Looking at our fair value models a little bit, this is the implied gain versus the bottoms-up price target. But just to talk about our fair value model in the background a little bit, currently for the S&P 500, that model using consensus rate and macro expectations would land somewhere in the mid 6,000s mark. The issue with the fair value model right now, we've been running that out of sample since 2018. Obviously, that's not picking up a lot of the valuation gains that we've seen in the Mag 7, so it's undershooting on the valuation side. On the earnings side, it actually also is undershooting, but for a different reason, and that's given the weak macro backdrop that we currently have. So it uses things like the unemployment rate, new orders growth, things like that are kind of assessments of the whole U.S. economy. Those are a little bit persistently weaker than what the bottoms-up consensus would suggest for the S&P 500 earnings stream, again, kind of given the distortion of the Mag 7. Nonetheless, if you look at bottoms-up price targets and the difference between bottom-up price target and today, currently the bottom-up analysts are suggesting about a 15% gain for the S&P 500 and 25% for the Russell 2000. Those sound like big numbers. They are. Typically consensus on the bottoms-up price target side, not on the EPS side, tend to overshoot gains in both large and small caps. They do tend to, however, get the general direction a little bit right. So in this bucket between 10 and 20% gains, implied gains for the S&P 500, you're looking at about an average 8.5% gain for the large cap gauge back to 2004. On the Russell side, that greater than 25% or that 25% gain suggested for the Russell 2000 implies about a 10% gain for the Russell 2000 historically on average back to 2004 again. So don't just totally throw out the bottoms-up price targets. They are generally constructive. Our fair value model, again, on the S&P side especially, is just persistently undershooting reality and probably will continue to do so as long as the Mag 7 dominate. Now, looking at the Mag 7, we are not in the AI is in a bubble camp. The main reason for that, I would say, is this chart right here. So if you think about the 4 horsemen of the internet bubble, Cisco, Microsoft, Dell, and Intel, those stocks collectively, if you aggregate it up, they traded at an aggregated 80 times forward PE, or trailing PE, excuse me. The Mag 7 currently is at only about 36.8, and that multiple has actually been falling since 2021. We were north of 45 times at the high in 2021, and we've been growing into our multiple for the mega caps. Now, you might say outside of the mega caps, some of these smaller AI names are also in a bubble, but pretty much by any valuation metric we like to look at, small caps participated in 2000, especially the unprofitable cohort of small caps. Those traded 5 times the valuation of the profitable cohort of small caps back in 2000. Right now, we're at 1.5 times. So small caps not participating. Leverage ratios are significantly lower in the U.S. than they were back in 2000 and even going into the great financial crisis. And just other valuation metrics just do not point to AI being in a full-blown bubble. I would even argue that 2021 was more exemplary of a bubble in the U.S. than what we're currently going through right now. And that 2021 bubble, by the way, I'll put on my small cap hat for a minute, was in smaller cap healthcare, where those stocks are largely unprofitable. Moving on, just a little bit about Venezuela and some recent developments that we've seen. I think what's going on in Venezuela could be a longer-term bullish play for the U.S. Obviously, this is going to take a lot of time to revamp their oil infrastructure to get energy capacity back online. So it's a very much longer-term play. But there's several reasons why it could be constructive for stocks over the long run. First of which, lower oil just generally is good for stocks now. Obviously, these oil price tranches that we've kind of determined here, that's going to be muddied by recession timing. Oil tends to collapse during recessions when global demand falls, tends to recover with global recoveries. So it's going to be a little bit muddied, but typically stocks do best in lower oil price tranches, right? Above 100 is undoubtedly bad for stocks. Somewhere around where we are right now, 50 to 65, pretty good for stocks. You're looking at an average 8.8% gain for the S&P 500. So that's constructive. The other way it's constructive, obviously, is keeping headline CPI lower. Now, of course, the Fed is going to use core PCE for any of the rate cut decisions, but given the political pressure at the Fed, I can foresee a situation where they use that as air cover to continue their rate cuts as headline CPI and headline PCE comes down, given lower energy costs. Again, a longer term play here. And lastly, I'll just close out with small caps. This is our current small cap fair value model. I would argue that small caps are much better supported near their all-time highs than large caps are, given our model and what macro is currently saying. So rates consensus currently would arrive at a 1.41 times price to sales multiple a year out for the Russell 2000. The current run rate of macro variables given consensus, about 3.4% sales growth. I'll note that 3.4% sales growth is also undershooting what consensus suggests for the year ahead. They see a return to trend, which is around 4.5%, 5%. So if you do believe the bottoms up consensus, multiples are pretty well supported for the Russell 2000. Bottoms up consensus suggests some upside on sales growth. And therefore, the Russell 2000 is a little bit better supported. But with that, I'll hand it over to Laurent. Thank you.
Okay, thanks, Michael, and welcome to our listeners. So moving on to European equities, 2025 was a good year. The Stock 600 was up about 17%, and this is mainly due to the strong performance of financial and industrials. Those two sectors accounted for about 40% of the gain of the index last year. However, on the left, if you look at the composition of total returns for most of the sector, it was driven by multiple expansion and dividend payment, and that because earning growth continued to disappoint over the year. And on the right, among the large European countries, you have Spain and Italy outperforming due to their large overweight in financials. Now, looking at the 2026 EPS outlook, the consensus is for 10% growth, but this is back-end loaded. We have 6% in the first half, accelerating to about 15% in the second part of the year. We think that there are some risk to this number because first, I think it will require a stronger economic backdrop for Europe than what we had in 2025, and for the time being, it's not yet in the economist consensus. And also, many European companies now are facing competition from China in segments like autos, chemicals, machinery, and consumer products. A strong U.S. economy, which is pushed by both fiscal and monetary stimulus, is definitely a plus. But I think there are still some contentious issues between the U.S. and Europe. The first one being digital tax on U.S. tech in Europe, and also now the control over Greenland. So I think potentially European companies are not immune to further tariffs in 2026, and potentially the last risk is going to be any renewed weakness of the dollar, given that we are in the 115 to 120 range, and when the dollar usually or the euro goes above 120, it puts pressure on earnings of European companies. If you look at countries, the CAC is expected to deliver the strongest increase at about 18%, and it's mainly linked to an expected rebound in consumer discretionary segments like autos or luxury goods. Now, if you look at the earnings momentum, and one of the reasons why we have a more cautious view on 2026 in terms of EPS growth rate, we are around about 6 to 7% compared to the 10% consensus. This view for the moment is being reinforced by the lackluster revision trend in Europe. So we can see on the left, the 2026 earnings estimate of the Stock 600 is slightly down with more downgrades than upgrades. Materials is currently seeing the strongest momentum thanks to the mining companies, especially in the UK, and it is also followed by financials and communication services. What is interesting is on the right, you can see the detail by region and by sectors. And overall, the comparison is not flattering for Europe because, as you can see, Japan, US, and emerging market in US dollar, all those markets are seeing stronger earnings momentum than Europe, which is at just 1% upgrade for UK and minus 0.3% for Europe ex-UK. Now, moving on to valuation, the forward PE of the Stock 600 is close to its historical high if we exclude the COVID period. In March, April 2015, the market reached close to 16 times forward earnings, and it was just at the time that the ECB was starting its QE program, and also bond yield in Europe was much lower than what they are today. Also, on the right, what we do is to compare the PE of European companies with the weight of US sectors, because we often have the question, given the discount of European companies' valuation compared to the US, isn't it a good opportunity to buy? However, given the difference in the index composition, if you put a European index with the US sector weight, in fact, the market multiple will go to about 18 times, and the discount now compared to the S&P 500 is about 23%, which is back in line with the average of the past 10 years. And the peak of this discount was in November 2024 when it was 44%. So definitely we have started to see a beginning in the closing of this gap, and any further closing, I think, would require higher earnings outlook for Europe. Now, looking at some of the sectors which may be interesting in 2026 in Europe, the first one, no big surprise here, is financials, where earnings continue to surprise on the upside. As we can see on the right, market is expecting about 8% growth for this year, which is an acceleration, a slight acceleration versus 7%. This is mainly driven by top-line growth, but as well as margin expansion because of higher yield, and also banks continue to have a strict focus on cost control. In addition, if you look at the valuation of European financials, you can see here, it remains at a significant discount to the US peers for level of return on equity for 2026, which are going to be equivalent or even higher. So we definitely think that this is a sector where we could see further valuation re-rating if earnings surprise on the upside. The second sector, which I think could be of interest, is industrials, because it will benefit from several trends. The first one, increasing defense spending. You have also the infrastructure program in Germany, and you have the continued investment in energy transition. If you look at the different segments of industrials, you have about 10-11% EPS growth for the next 3 years expected in construction and engineering. And for electrical equipment and aerospace, you have earning growth between about 17 to 19%. When you look at valuations, the valuation of both construction and engineering and also electrical equipment are not that excessive compared to history. And also their price to earning growth ratio is about 1.5 times, which is below the average of European growth companies, which is around 1.7 times. If you look at aerospace and defense, I mean, after the strong rally that we have seen over the past 6 weeks, we think that the valuation is now fair, and so the PEG ratio of this sector is at about 1.8 times, which is slightly above the one of the Magnificent Seven. So we think that at this point we need to see further upgrade in this segment to justify higher multiples. Now, last point on defense spending, because it's a question that we get quite often from customers. It is about the fiscal constraints that we have in many countries like France and Italy. And we think that despite those fiscal constraints, it's not an obstacle to strong top line growth in this segment. And there are two reasons for that. The first one is because companies should benefit from a higher spend on equipment in defense budget compared to personnel or administrative costs, and it is because many countries have to replenish their inventories of ammunition and others. And also the portion of equipment coming from Europe should increase over time, given that a lot of the money is likely to be provided by the European Commission through the ReArm program, which has a clause of at least 65% of the supply has to come from European countries. So even if on the computation we made, many countries are not going to reach the 3.5% target of GDP spending in defense by 2030, we still estimate that the addressable market of many European defense companies will be in excess of 20% a year for the next 5 years. Now, looking at European countries, our scorecard still favor Italian equities, which has been on the top of our past country scorecard for quite some time. And now it is followed by the UK, mainly driven by the financials and also materials. On the other hand, what we have seen, Germany, which was very strong at the beginning of the year, has now slipped at the bottom, given a relatively poor earnings revision trend compared to the other European countries, and also now high valuation, which led to some profit taking in the month of November and a bit in December, which led to weak technical indicators as well. The last point I want to make on European equities is on the valuation of the Stock 600 index. We currently have a fair value of 620, which is based on a 15-time forward PE and a 2027 EPS estimate of 41. Now, moving on to Japan, which also had a pretty good year in 2025. The Nikkei was up 26% for the year. I think one of the key questions is how far will the BOJ raise rate, and is it already discounted in Japanese yield? So first, if you look at the economic forecast of the BOJ and you use a Taylor function in the terminal, what it indicates is that potentially the central bank should raise its rate to about 1.5% compared to 0.75 for the time being, which is in line, in fact, with the money market expectation for the end of 2027. Now, when you look at the price of bond yield in Japan, if you look at the short end of the curve, in fact, it implies that the one-year rate in 12 months' time will be about 1.5%. So it is quite close also to the neutral rate. And even if you add a 100 basis point of term premium, given all the fear of the fiscal dominance with the election of Sanae Takaichi and the impact and the fiscal policy she will drive, I mean, it can give you a 10-year yield of about 2.5% over time, which is, while currently it is at 2.2%. So definitely there could still be some pressure on Japanese bond yield, but we think that most of the trend of higher rate has started to be discounted, and we do not think that it should impact the valuation of Japanese equities that much. Now, looking at the yen, which is a major driver of Japanese earnings, I think the path forward is definitely going to be volatile, given potentially some renewed weakness in the dollar. But what we can see on the right is that the current market positioning from investors, both hedge funds and also long-only asset manager, is that the market positioning is not as bearish today than what it was in July, August 2024, when we saw this unwind of yen carry trade trade, which led to a mini crash in Japanese equities. So for the moment, we have a more sanguine view on the dollar compared to the yen. And if the currency remains where it is today, in a range of, let's say, between 156 to 159 or maybe close to 160, I mean, it will remain a major tailwind for Japanese exporters because at the end of the September quarter, most of their currency forecast for their fiscal year was between 145 to 147 to the dollar. So definitely it could provide a tailwind to some of their numbers. In terms of valuation for Japanese equities, the way we look at it is to look at the price to book of the index compared to global markets. And we can see that Japan does not compare favorably on this metric. And I think the higher profitability, which could be driven by a weaker yen or the change in corporate governance, which could be positive for higher dividend payment or share buyback, I think it starts to be already discounted in the price of Japanese equities. Currently, they trade on a forward to book price to book ratio of 1.7 times, which is a slight discount to European markets, but their ROE is about 30% lower than Europeans. So definitely we need to see better numbers to see further re-rating of Japanese equities. Now, looking at sector allocation in Japan, what we are looking at is at the top, technology and financials, and at the bottom, we have staples and materials. And the last point I would like to make is on the valuation of the MSCI Japan index. We had a fair value of 22.25 when we did publish our earnings outlook at the end of November. We have already seen a 10% rally in the market since then. So we're revising with the latest numbers. We have now a fair value of around 2,300 on this index. And on that, I will stop it here and leave the floor to my colleague Marvin Chen. Thank you.
Thanks, Laurent. So my name is Marvin. I cover Asia equity strategy, and today I'll give a brief overview of how Asia stacks up against the rest of EM and the world, and then dive a little bit deeper on China. So, if we go back to 2025, the first half of the year was really characterized by valuation re-rating and the weaker dollar. Overall, it was a pretty good year for EM, despite all the tariff volatility and geopolitical tensions. Emerging markets ended up around 30% this year, the best year since 2017. So the question is, can EM repeat its outperformance this year? And, we think that this will depend on earnings going forward, as valuation re-rating has largely been complete last year. So here we're looking at, emerging market EPS, whether we're looking at the MSCI EM index or Bloomberg's EM index, it's at the highest level since the global financial crisis. So expectations are high going into this year, and it will be important for kind of these earnings to materialize. So, where is this earnings growth coming from? For the past 2 years, it's been the tech and AI demand for semiconductors that continue to drive earnings for the chip makers in Taiwan and South Korea. In terms of revisions, it has since about the third quarter of last year, it has all been about Korea. Since over the past several months, Korea estimates have been revised up by over 20% now, really benefiting from the surge in memory prices as the AI investment cycle shifts. Upgrades in Taiwan and South Korea have helped offset, slightly downward revisions in China and India, and have kept the overall EM outlook a bit higher than it was in the second half of last year. So the tech demand is still key for the earnings outlook in the region. In terms of valuations, they are getting a bit stretched. emerging markets are now trading one standard deviation above historical averages. Here we're looking at a table breakdown across markets and across sectors of the Ford PE 5-year Z-score. We can see even China, which has seen trough valuations over the past two or 3 years, is also now trading back above its 5-year average. What is interesting is that, Korea, even after a world-beating rally of nearly 100% last year, valuations are still slightly below average, with this tech sector still trading at a historical discount. So this is really reflecting, speaks to the strength of the earnings outlook for Korea this year. And we're seeing that kind of play out in markets right now. Year to date, Korea is up another 10 to 15% just in the first few trading days of the year. But overall, the green boxes here do highlight some of the valuation opportunities in terms of valuations across the emerging markets. So this is our EM scorecard. It ranks the markets on various fundamental and technical factors. We update this quarterly, and we did this in December. The key message for the start of 2026 is that Korea looks favorable within Asia, while commodity exposed markets such as South Africa and Brazil may also see some momentum. And my colleagues Jenny and Andrew can give some more details on that later on. But the overall message is that commodities, precious metals, and tech, these were the key drivers in 2025 and may continue to be so in the early parts of 2026 as well. Other big climbers on the scorecard were Indonesia and India. China was at the top of this scorecard this time last year, but has kind of fallen to the middle of the pack, largely due to valuation. So just a bit more on China. As mentioned, valuations are kind of above the 5-year average, of most sectors trading above average. So the question is, can China re-rating continue? With the broader market, China market kind of sitting above average valuations, we think it will be difficult without earnings recovery. But what is interesting is if we look at the sectors that are still kind of discounted versus historical averages, it's the consumer sector, communications, and healthcare. These are the sectors that have been labeled as new productive forces and priority growth sectors for China going forward in the next few years. These sectors include the tech giants, the e-commerce platforms, the EV sectors, as well as some of the new consumption sectors that account for roughly 50% of the index. So whether China stocks can continue to re-rate will largely depend on these consumer and healthcare and new economy sectors. In terms of tech, obviously, given the importance of the tech, ongoing importance of the tech theme, we do track the China Tech 8, which is our version of the Mag 7. If we look at the valuations, the valuation for the Tech 8 are still relatively undemanding, trading at roughly 20 to 50% discount versus the Mag 7. Now, if we look at the bottom section of this chart, this valuation discount wasn't always the case. Back in 2023, China Tech 8 and the broader China Tech was trading on par with the Mag 7 and the Nasdaq 100. And the key driver of this divergence has really been been AI. But now we're seeing some of this gap closing as China makes progress on its kind of own internal AI development. So, the consensus is, China AI development is behind that of the US, but it also means that potential growth is in the future. So if we look at the growth profile of the China's Tech 8, it's expected to accelerate in 2026 after contracting last year. If we look at the earnings growth profile of the Mag 7, it shows that it has potentially peaked in 2024 and decelerated in 2005, and is expected to continue to kind of edge lower in 2026. So we think, as the global AI cycle kind of matures, we may see some rotation towards China tech going forward. Another theme that we're looking at is supply side reform, and this is China's effort to kind of reflate the economy. China's producer prices have been in deflation since about 2023, but starting in the middle of last year, policymakers are embarking on reform again. This includes reduction in overcapacity and trying to curb price wars amongst and industry competition. So the last time they did this was at the end of 2015. It took about a year to kind of end the deflationary cycle. During that time, China domestic A shares saw sustained momentum. So we think this, given that it takes about maybe a year to 2 years to kind of see this reflate the economy, this will be a key theme to watch going into this year. This is one of the main reasons that China A shares have caught up in the second half of the year after remaining pretty much flat for much of the first half of 2025. To start 2026, we have seen onshore A shares kind of catch up to the offshore listed China stocks, but they are still kind of lagging behind. And one key reason why we think supply side reform benefits A share more is that the market is more heavily weighted towards materials and industrials, which account for roughly 25% of the CSI 300 index versus less than 5% of the Hang Seng index, which is mainly made up of many of the larger tech names. Lastly, I just kind of want to highlight our China Sentiment Indicator. This is the model we developed on Bquant and is available as a BPAC app on our strategy dashboard. We track 7 unique indicators for China to measure market sentiment, and it's divided into 5 zones ranging from exuberant to capitulation. And what you can see here is that even despite the tariffs and geopolitical tensions, sentiment really has been, China sentiment has really been kind of enthusiastic to exuberant for much of the past year. And this is a big contrast to the 2022 to 2024. Sentiment was largely in panic mode zone, and the sentiment shift really happened after the September stimulus blitz of 2024. Here are the 7 components of the indicator. We track on short-term measures such as liquidity measures such as margin balance and turnover. We have unique indicators such as new sentiment on the Bloomberg terminal, as well as more traditional indicators such as cyclical versus defensive. The good news for China is that most of the more medium to long-term structural indicators, such as cyclical versus defensive, and the performance of private enterprises versus state-owned, are still, holding near historical high, which bodes well for the medium-term outlook. We think it's also good that not all indicators are kind of hitting this exuberance zone, because when we see that happen, this has been historically associated with negative forward returns over the next 1 to 3 months. So we can see here there's room for further momentum, particularly if the northbound Stock Connect turnover picks up, and this is an indicator of foreign investment participation. So lastly, we also do run a sector scorecard for China, tech, communications, and discretionary healthcare at the top. Again, these are the sectors that align with China's new productive forces and the new economy. And, this will be kind of the key area of focus for growth over the next several years. With that, I'll stop here and hand it over to Jenny. Thank you.
Thank you, Marvin. Good morning or good evening, whatever you are. I'll switch gears now and walk you through our outlook for LATAM equities. Let me see if it can yeah. Okay, so starting with a brief recap of 2025, LATAM was among the best performing equity regions globally. The MSCI Latin America rose about 30% in local currency and 46% in US dollar terms. It was the region's strongest annual performance since 2009. Looking at the performance decomposition, a key driver of returns was currency appreciation and multiple expansion, reflecting really an improvement in sentiment towards the region following a very sharp compression in 2024. So forward price to earnings for the MSCI LATAM expanded by nearly 40% last year, from around 8 times in the beginning of the year to roughly 11 times currently. And we can see that this re-rating was broad-based across all the key markets, which reflected a more supportive backdrop with the Fed starting to ease rates, resilience towards US tariffs, very cheap valuation levels, and of course, we have some political developments with elections in key markets across the region. I see that Carlos sent a question here around elections. I'll address that later on. With these optimists towards Latin America, we saw some renewed interest from global investors. Our emerging market fund manager review shows that active managers maintain an overweight position in Latin America through the first 3 quarters of last year. On average, the exposure among the top 100 emerging market funds was around 11%, compared to a benchmark weight of roughly 6 to 7%. At a country level, Brazil remained the largest active overweight, with positioning widening even further through the first 3 quarters of last year. Mexico followed, and managers were broadly neutral on Chile, Colombia, and Peru, with dispersion actually widening in Chile in the third quarter, ahead of elections last year that happened in the fourth quarter. Active positioning in Argentina continued as well, but dispersion narrowed significantly when we compare to early 2025. Now, turning to valuations, Latin America continues to screen attractive relative to global peers. This dynamic table from our BI Stock3 dashboard shows that most of the key Latin markets rank in the cheaper half of global markets when looking on the price to earnings ratio and other valuation multiples as well. I think Peru stands out here as one of the most expensive markets, trading at a somewhat higher levels on a price to sales basis, especially. And relative to global markets, Latin America continues to trade at a meaningful discount as well. So currently, the region trades at a more than 40% discount to global markets, which is more than double than its long-term average discount of roughly 20%. And historically, these valuation gap levels have been associated with approximately 14% annualized returns over the following 5 years in US dollar terms. On a sector basis, valuation is supportive as well. Currently, 8 of the 11 sectors trade at discount relative to their emerging market peers. Financials and utilities, they stand out as one of the few more expensive sectors. Their 10-year Z-score are above 1, and financials trades at a more than 60% premium on a price-to-book basis versus emerging market peers, and also 30% above its own historical mean as well. On earnings, we have this tracker. This is our earnings call sentiment model. It shows that the tone of management commentary improved in the most recent earnings season, recovering from a drought in the first quarter of 2024. Mentions of terms related to tariffs and inflation per call have declined, suggesting some reduced concerns around these topics. Just a reminder that this sentiment score, it aggregates positive and negative language in management prepared remarks during earnings calls with analysts. And looking ahead in 2026, consensus expectations for earnings growth have slowed down from double-digit growth in 2025 to mid-single-digit growth this year. While this trails the broad emerging market index, which has been largely driven by tech names, technology earnings, it still compares favorably to some other emerging market peers. So it's in line with the growth expected for emerging market Asian countries and above India as well. Now, turning to elections, one of the key drivers I think that's going to continue influencing markets this year is the political cycle. So we have elections scheduled in Colombia and Peru in the first half of this year, and Brazil in the second half. We do have expectations of a political shift following these elections, which have been a very important source of optimism for the region, like we saw last year in Argentina and Chile, for example. And then just addressing the question that Carlos asked here, some analysts have been referring to electoral trading Latin equities driven by these expectations of more market-friendly governments. Do you believe the U.S. action in Venezuela reinforces the thesis in a year with elections in countries such as Colombia, Brazil, and Peru? So we didn't really see a strong reaction in markets following the capture of Maduro by the U.S. Really, the main channel that we see is through oil prices, but I think at this point we all know that it will take years for the infrastructure in the country to be rebuilt. As for the political consequences, I think it really reinforces the view that the U.S. views Latin America as the region that it's within its scope. So our hemisphere, like the State Department have even said, I think it could intensify some more anti-intervention sentiment among voters, which could even boost incumbent governments, like we saw when trade tensions flare up between President Trump and Lula last year. I think it's difficult to say how much it will influence polls, but it does intensify a lot of the political polarization and debate around really the U.S. influence in the region. So I hope that sort of answered your question, Carlos. If anything, if you have more questions, feel free to reach out to me later on. So I'll conclude my part here with our latest Latin American equity scorecard. Chile currently ranks at the top, supported by strong technical signals such as price momentum, price breadth, and also earnings dynamic. Peru follows second. Brazil sits in the middle. It's weighted down by weaker technical indicators, and then Colombia and Peru are at the bottom. Unfortunately, we are short on time, but if you want more details on the methodology, the note was just published this morning, so feel free to reach out to me. I'll be happy to share the link. And with that, I'll hand over to Andrew to discuss the EMEA outlook for 2026.
Thank you, Jenny. And thanks all for joining the call. So now I'll spend the next 7 minutes covering EM-EMEA strategy. When we talk EM-EMEA, we generally think of Poland, Turkey, the Gulf equities, the most liquid ones, the Saudi, Qatar, UAE, and South Africa. By the way, EM-EMEA would be the last region we'll make a dive into. So if you have questions, just post them in the Q&A, and I think we'll have 15 minutes to answer as many questions as we can. So overall, the outlook on EM-EMEA is shaped by the following drivers. The global drivers we think will continue to be supportive for EM-EMEA, namely a weaker dollar, the non-recessionary US easing. We think that the elevated valuations of US stock market and the desire to diversify will be supportive for the EM equity flows. The EM specific narrative is also supportive, and I'm specifically watching the growth differential of EM equities and DM equities, which IMF estimates to widen. Generally, this is a supportive factor for the EM equities as an asset class. And now let's dive into the idiosyncratic drivers of the constituents of EM-EMEA. Let's start with South Africa, arguably one of the best performers last year, adding 60% in dollars, and the metals and mining sector added more than 200% in dollars in 2025. So this year, we think that the rally can broaden into domestics. The economy is set to grow at 1.5%. Yes, not much by EM standards, but this is compared to less than 1% growth for the last decade. We see green shoots in consumer spending, which are growing across all major categories. This is driven by real wages growth, lower inflation, and the central bank adopting an orthodox monetary policy and now targeting 3% inflation. So we think that consumer and domestic names, namely, is going to be has chances for to capture the next leg of the rally. There are some risks, though. Unemployment remains high. The government of national unity continues to deliver on the reforms, but market thinks that still this government of national unity can be in a shaky form. But our outlook for the reforms it's still positive. So the next market is Turkey. We think that here the narrative is shaped by the disinflation and the continued easing of the central bank policy rate and the continued lower inflation. The market has went through a long period of hyperinflation. You can see that inflation used to be around 78 to 80%, just 4 years ago. We think that this year the inflation for the full year has been around 31%. For the next year, we think inflation would be around 22%, and the central bank policy continues to be restrictive. At year end next year, we think is going to be around 27%. The beneficiaries for that are mainly banks, given their positive gearing to lower rates. Especially, we think that Yapı Kredi and İşbank could be the beneficiaries, given their reliance on the repo funding, which reprices fastest. Position in Turkey remains very light, given that last year same narrative was around. People expected inflation to be lower, the disinflation to continue. The central bank was expected to fight increased inflation, but there was a spike in political risk driven by the unexpected arrest of the opposition leader. We think this year the market would be willing to give the benefit of the doubt and look at Turkey again. Another market on our radar is Poland. I think that the general narrative has been multiple rating, as market has been softening to the case of Russia-Ukraine, like the end of the Russia-Ukraine war. We see that in late 2021, on 12-month forward P, Poland was trading in line with emerging markets. The discount has widened to around 60% in middle of 2022. Right now, the discount to emerging markets on 12-month forward P is around 20%. So there still remains room for improvement for a multiple rating, dependent on how the sentiment around Russia-Ukraine would develop. The economy is estimated to grow around 3.2% this year. Again, it's quite a decent margin to European peers. We think that there is sort of a challenge in the political landscape. The president and the prime minister are in the opposition, which sets the stage for challenging 2027 parliamentary elections. However, that would pave the way for social transfers, which is positive for consumer. So we in Poland, we continue to like consumer. The indicator we are watching is the household savings rate. It continues to be elevated despite the real wages growth, despite the policy rate is easing, the disposable income is increasing. But Polish consumer remains in the defensive mode and not really spending. So we think that again, the Russia-Ukraine conflict would reverse or normalize the savings rate, and that's when Polish consumer will start to spend. So we prefer Polish consumers over financials. We think that outlook for financials is challenging. Again, the social transfers opens the way for budget deficit, and it's growing. The budget deficit is growing. So government is trying to find the ways to plug the hole in the budget deficit. And one of the ways has been the increased taxation for banks. This is denting margins. This is denting earnings. And we think consensus is still yet to price in full that hit on bank earnings from the increase of taxation. Last but not least, Saudi Arabia. I think Michael on the call earlier was mentioning that U.S. returns when oil is around 100 are catastrophic. So then strongly encourage you to look at South Africa. One may say that it's quite straightforward to build on paper the outlook for Saudi Arabian equities. Just take a view on oil, take a view on the dollar. This is a market that in the economy that mainly exports oil, obviously. The oil is priced in dollars. So for Saudi Arabia, strong dollar and strong oil is positive for the equities. So last year, oil was down, dollar was weak. Saudi Arabia has underperformed broader emerging markets. But this chart actually shows you that on paper, this may look easy. There are more complications under the surface. So here you may see that there has been quite strong correlation of oil and index earnings until 2023. This is when the heavy borrowing was seen. The economy, the Saudi government is still attempting to diversify the economy. The break-even price for Saudi budget is around 100. So obviously, right now oil trading around $60 per barrel. There is a growing budget deficit. So this is being plugged in by increased borrowing. So right now you see that the corporate world, Saudi Arabia government spending is has a big role in the corporate earnings. Despite falling oil due to the government borrowing, the earnings are holding flat. And if you look at banks, this blue line, banks' earnings are actually increasing. This is the sector that is driving economic diversification. So we see that correlation really broken and continue to be broken with Saudi on the way to diversify the economy and increasing the borrowing. So that's it from my side. I think I'll return it to Jillian and we address the Q&A.
Thank you, Andrew, and thanks for everybody who's attended this call today. We are running out of time as we do have a hard stop in about 1 minute. We reached out to a few of you individually who have Q&A questions in the chat. We are keeping track of all of these, so if we aren't answering them right now, we will follow up pretty shortly after this. Michael Casper had to step away for a moment, but he will follow back with a few questions we have on the U.S. I had a few questions on Canada. I will respond to you all directly with that. Again, just a reminder, we will be publishing the replay and the slides for this. I can send those along to anyone who's requested, and they will be in our distribution note. So thank you, everyone. I hope you enjoyed the rest of your day and the start to the new year. Thanks all.
Recording